So is now a good time to start investing in the stock market, or if you're already invested in the stock market, is it a good time to continue to invest? In today's video, I'm specifically going to be focusing on investing in ETFs or exchange traded funds, but this video should be useful for anyone who is thinking about investing or who has already started investing. So the last few months have been pretty appalling when it comes to the stock market. So the S&P 500, which tracks those top 500 companies in the US, is down just over 5% year to date. And some of the ETF investments that I have made are down even more than that, but I'm okay with that, and I'm going to tell you why. So if you're new to investing, then you might be thinking, what have I done? Everything I've invested in has lost me money. I should have just stuck with saving into a high interest savings account or putting my money into, say, for example, premium bonds. Now, if you were looking at the short term, then that certainly would be the case, but over the long term, investing should bring higher returns. Now, I want to give you a very specific and personal example of just that. So I am invested in an ETF, which is the iShares S&P 500 Information Technology Sector ETF. So as I said previously, the S&P 500 is the top 500 companies in the US. And so when you're investing in the ETF that I'm talking about, you're investing in just the tech stocks from the S&P 500. Now, the performance of this ETF has been appalling year to date. So year to date, it has lost a whopping 15%, which is obviously huge. Tech stocks have been hit particularly hard in the last few months. And if I was a new investor, this would certainly be putting me right off. But if in doubt, it's really important to zoom out. And if you look at the returns for this ETF over the last 5 years, it's actually made a whopping 157% in the last 5 years. So if I was looking in isolation at the year-to-date performance, I would think absolutely not would I want to touch this ETF. But looking back over 5 years, it has performed very, very well. And also what I think is very important to mention when you're looking at investing in ETFs is that you should have a look at their risk levels and their standard deviation, because that is a really good measure of risk. So when I invested in this specific ETF, I was looking at the long-term horizon, and I also had a look at the risk levels and standard deviation. So I knew that this was a very risky investment to be making, but what I was hoping for was that those higher levels of risk would hopefully lead to higher levels of return. Now, that isn't always the case with investing, but that is what you hope for. So yes, this ETF has on paper lost me 15% in the last few months. However, over the last 5 years, including the last 3 months, it has made me 157%. Now, this specific ETF doesn't make up the majority of my portfolio. The majority of my portfolio is invested in a simple FTSE All-World ETF. The one that I have is the Invesco FTSE All-World ETF because the fees are nice and low, but there are many other options available for FTSE All-World ETFs. So on paper, in the last few months, I have lost thousands of pounds. However, I am not selling these investments, so these losses are just on paper. And actually, if I look at the longer term and the time frame that I have been investing, I have made much more than I will have lost in the last 3 months. But again, it's on paper and I'm not selling these investments. And if you take a look at the video that I made a few weeks ago, you will see that I'm continuing to invest in these ETFs. So I added to my position in IITU. So that is a smaller satellite position and makes up a smaller proportion of my portfolio, because it is a higher level risk investment. But I also added to my position of the FTSE All World. So what I'm seeing this as is not lost money. I'm seeing it as an opportunity to buy the ETFs that I want to buy at a discount, because at the moment I can buy them for much less than I could a few months ago. And when you start investing, it's really important to consider that market crashes and market corrections do happen regularly. And history has shown us that although it might take some time, the market does recover. So let's look at 3 of the most recent market crashes. So first of all, let's look at the dot-com bubble. The Nasdaq was the epicenter of the dot-com boom and the subsequent crash. From its peak in March 2000, the Nasdaq lost about 78% of its value by October 2002. But by 2007, the Nasdaq Composite had fully recovered from the crash and reached new highs, surpassing the peak of the bubble in 2000. Okay, the next crash that we're going to look at is the 2008 financial crash. So the S&P 500 index lost about 57% of its value from its peak in October 2007 to its trough in 2009. However, the US stock market started started to recover in 2009, with the S&P 500 returning to positive growth by 2013. So yes, it did take a number of years, but it did recover. And finally, our most recent 2020 stock market crash. So the global stock market lost over $30 trillion in value between February 2020 and March 2020. And the S&P 500 dropped by 34% from its peak on February 19, 2020 to its trough on March 23rd, 2020. After hitting its low in March 2020, the stock market began a rapid recovery. And by August 2020, the S&P 500 had regained its pre-crash levels and reached new record highs. So what I want to avoid doing is, through fear of losing money, actually not investing at a discount when hopefully over time the market will recover. Unfortunately, when it comes to investing, market downturns are unavoidable. And even if you're going with a really diverse option like a FTSE or World ETF, you still will see market downturns and corrections over the course of your investments. But what you don't want to do is avoid investing altogether and potentially miss out on the gains that you could see over time from investing. Now, there's a really interesting psychological concept called the loss aversion bias that explains why people tend to prefer avoiding losses rather than acquiring equivalent gains. This concept is a key element of the prospect theory developed by two psychologists back in 1979. According to this theory, the pain of losing money psychologically is more powerful than the pleasure of gaining the equivalent amount of money, leading people to make irrational decisions in their financial and investment behavior. Loss aversion often leads to risk aversion, and not investing would be an example of risk aversion. Investors are often overly cautious or conservative in their choices to avoid potential losses, even if the potential for gains outweighs the risk. Investors may choose safer assets like bonds or cash instead of stocks, even when those safer options offer lower returns over the long term. While the investor avoids the possibility of a loss, they may miss out on better growth opportunities, which can ultimately hurt their financial goals. This concept also covers the overreaction to market declines. Loss aversion can lead to panic selling during market downturns. Investors feeling the sting of unrealized losses, which is what I've got, paper losses essentially, may sell off investments in response to market volatility or downturns, often at the worst possible times when prices are very low. This behavior can lock in losses and prevent investors from benefiting when the market recovers. So what I will say when it comes to investing, it is better to look at a longer term horizon. So if you're saving for something like your wedding next year, I certainly wouldn't be putting that into investments. But if you're investing for something that is in the long term, say for example your retirement, or say for example you want to save for a house and you're not planning to buy that new house for another 10 years, then investing might be a good choice for you. But I totally understand that the last few months have been very stressful, and if you're saving for something that's in the near future, then potentially investing isn't for you. But if you're looking to invest for the long term, for really far ahead future goals, at least really 5 years or more, then investing might be a good option for you. When you're looking at investing in exchange traded funds or ETFs is a very simple way of getting a very diverse portfolio at a low cost, which is why I personally like to invest in ETFs. I have so many videos on this channel about ETFs specifically. I have this video, which I'll link for you, which is some of the very best ETFs that are available on the market at the moment. If you do want to subscribe, I am getting incredibly close to 10,000 subscribers, and I would really appreciate you for subscribing. You absolutely don't have to, it's obviously free. If you fancy it, then please do. If you have any questions about anything I've shared in this video, then please do pop them in the comments down below. I really do try to get back to all of my comments, so I look forward to speaking to you there. Anyway, have a lovely day and thanks so much for watching. Bye bye.